We spent quite a while looking at the different market structures, and we've used them as a model to explain how firms behave. Now, there is another kind of alternative approach to doing that, and it's a really useful way of evaluating and kind of going for those really high-level answers when it comes to talking about how businesses behave in particular market situations. And the theory is called contestability theory. So what this video is going to do is it's going to compare market structure theory, which is what we've looked at already, with this idea of contestability theory. So just kind of summarize really how the market structure theory works. So market structure theory is the sorts of theory that we've looked at so far. So what we're basically saying is that we divide markets into various categories. So we've got perfect competition, monopolistic competition, oligopoly, and monopoly. So we've got these four kind of market structures, and the key determining factor of them is, as you can see on the first bullet point here, the market share of the firms. So in perfect competition, the market share is tiny. In a monopoly, the market share is very significant, and we categorise the markets based on the level of competition. The important thing there, though, is that it's based on the actual level of competition, so how many firms are actually operating in that market at the moment in time when we are considering it. And what that means is that if we have a business that is operating in a monopolistic situation, we are going to end up with the diagram that we can see there on the screen, where the monopolist will restrict their output to Q, that being the profit maximizing level of output where MC equals MR, and that meaning that they can charge a higher level of price. So that was the market structure theory, and actually for really quite a long time that was really the main model that was used to analyse business situations. But then it was realised that actually this wasn't a complete picture, because although there were firms that appeared to enjoy monopoly powers, they actually weren't taking advantage of this in terms of setting higher prices, and that's not really catered for in the market structure theory. So a chap called Balmol came up with this contestable markets theory, and the aim of the contestable markets theory is to try and fill in that gap in the market structures theory by explaining why in certain circumstances businesses, even if they do have power within the market, may not actually use it in order to set a price higher. So let's think about what contestability theory involves. Contestability theory then is basically a spectrum. So rather than a market structures model where we divided it kind of neatly into four categories, the idea with contestability theory is that it's a spectrum, and any market can exist anywhere on this spectrum. So it's kind of a sliding scale. So this will always crop up as like a to what extent sort of question, and you kind of can try and place it on the scale. Now, those markets which are less contestable, those are the sorts of markets that would have things like high barriers to entry, imperfect knowledge, and so on, things like that. So that they are the things that you would generally associate with kind of concentrated markets, but it's the barriers to entry. The really important one here, though, is high barriers to exit. High barriers to exit. We'll talk a little bit about what barriers to exit are in a moment. If a market is more contestable, first thing to note is that this does not mean perfect competition. Okay, the two are different. So although some of them are the same, for instance, low barriers to entry, as we would expect, and perfect knowledge, there are other characteristics here which are not the same as perfect competition. The key one being that there will be some price differentiation here. Okay, So what we mean is that that the firms have a degree of price setting power. Now, I just want to kind of talk a little bit about the barriers to exit. Okay, these barriers to exit that we refer to here. Okay, so barriers to exit are factors which prevent a firm freely leaving a market. So we've spoken a lot about barriers to entry, things that prevent a firm entering the market in the first place. A barrier to exit is something that makes it undesirable for a firm to leave the market, and principal among these is something that we call sunk costs. And sunk costs are defined as costs which cannot be redeemed when the firm leaves the market. So the way to think about this is, if I enter a market and I buy a van or something like that, when I leave the market I can sell the van and I can recoup my costs. So those aren't sunk costs. But if you imagine I spent my money on training staff or on marketing, I don't get those costs back. There's nothing that I have created that I can sell in order to recoup those costs. So those sorts of things would be considered as sunk costs. So these things often arise when we have specialised capital and or specialised labour as a result of training. So what this means is that the existence of these sunk costs means that it's unattractive for a firm to enter the market, because actually it will be difficult for them to leave the market again when they actually want to do so. So if a market is contestable, then how does it actually affect business theory? Well, the main thing is that it opens up a threat. So if a market is more contestable, just zoom in down here a little bit, we can talk about it over here. So if the market is more contestable, it opens up the possibility of what we call a hit and run attack. If a market is more contestable. And what this means is that if a firm is enjoying supernormal profits, so there are supernormal profits in the market, other firms will briefly enter the market to take advantage. Okay, so because the barriers to entry and exit are low, the firms which are outside of the market will enter the market to take advantage of the supernormal profits and then leave the market again very quickly. And we call that sort of thing a hit and run attack. The implication of this is that the monopolist will probably engage in what we call limit pricing to prevent this happening. So what this means is that the firms which are in the market, the ones which were enjoying their supernormal profits, rather than running the risk of one of these hit and run attacks, they may decide to set a lower price to prevent another firm entering the market and competing with them. They view it as basically taking a hit on their supernormal profits, having slightly less than they would otherwise have, is preferable to losing all of their supernormal profits as a result of hit and run attacks. So what they do is they reduce their prices, which is why we sometimes see that an industry which initially appears to be a monopolist still doesn't necessarily demonstrate these very high prices that we would associate with a monopoly. And the reason is contestable markets theory. So if we come back and kind of think about how we would actually use this briefly then, we would use this firstly as an evaluation of monopoly behaviour, because it may be a reason why monopolist firms may not charge as high a price as they are able. It's also an evaluation of the market structures model more generally. So you can always kind of use this as a depends on factor. It will depend on the level of contestability within the market.